And welcome back to the Financially Simple Experience. Friends, we're still on our quest for that 8-figure practice, that 8-figure business. As you may know from the last few episodes, we're dedicating this particular series to the financial advisors in our country, the financial advisors who serve clients to help them drive their wealth through financial instruments or through various methods of advice. You may say, Justin, why are we talking to financial advisors? You know, every week, literally every week, I speak to 10, 20 advisors nationally who reach out to me through the social media platform. They connect with me through my blog, Financially Simple. They hear me speak at a conference. I'm speaking at a few conferences over the next 6 weeks or so, and people will connect with me there. I teach at the Exit Planning Institute to actual financial advisors, attorneys, CPAs, how to build businesses that you can sell for profit and leave a legacy that so many business owners desire. And so because of the sheer number of questions and what I'm seeing at this particular point in our marketplace, it just makes sense to deal with the financial advisory practice. Now, again, if you're not a financial advisor, that's okay. That's okay. The concepts I'm going to teach throughout this entire series, as I mentioned every episode and probably will, it is apropos to business owners. We can apply the principles to any business, no matter what industry you're in. Now, in our last episode, I introduced a concept and I said, hey, you may want to consider a CFO, someone who can come alongside you and help you in the financials of your company. In that last episode, I mentioned a 2021 Fidelity benchmark study, which said only about 40% of current RIAs or registered investment advisors use a CFO to any capacity. And those that do, those business owners who are wise enough to pursue this particular mean and employ this particular professional for their business, are experiencing a higher growth and income and value growth than those who do not. You know, one of the pain points that we have as business owners is we're under high stress. Doesn't matter which business you're in. Now, in the financial world, the stress is crazy. It wasn't too long ago. Now, for me, it seemed like centuries ago, but it wasn't too long ago that I can remember in 2007, 8, and 9, during the Great Recession, as it's been coined, that I literally saw financial advisors throwing themselves out of windows. The business of giving advice on money is a high stress business. Because in order to give advice on money, you have to know the person to whom you're working, to whom you're giving the advice. You have to know their dreams, their aspirations. You almost become part of their immediate, cohorts, their board of advisors, which is what we desire in order for us to give our best advice. And so because of this, whenever life happens, when we go through these periods of extremes, whatever they may be, it impacts our clients. It impacts our business. It impacts our family. It impacts us. And so therefore, we go through this period of high stress. Another thing that many people don't understand about the financial advisory practice that you and I would deal with is we deliver work today, but don't get paid for 12 months for the next 12 months. So case in point, during the COVID pandemic, we ended up doing more work because we were business owners. We were spending almost twice as much time and energy working with business owners to help them survive the COVID pandemic. Our fees increased a little bit, but yet we were doing a compression of work during a very short period of time, but we didn't get paid but for the next 12 months. And so whenever you're dealing with those areas, your cost of goods are still flowing in, your expenses are still involved, especially as a business owner, you're having to pay overtime to employees during that time period, and you're not going to get paid for 3, 4, 5 months. So it creates a high stress position. So one of our pain points is, as business owners, especially in the RIA space, is we're highly stressed. We also experience stagnant growth. It's very hard to go to clients and raise fees, especially in the financial world where fees are a very sensitive topic. For us consulting with business owners nationally, it's very easy for us to illustrate that maybe perhaps a dentist should and could raise fees 2 and 3 times a year. I was talking with a business owner. He said, yeah, even my landscaper increased my bill and said, hey, here's the new bill. And it was, okay, well, I get it because the price of fuels went up. The price of labor's gone up. To raise the price on mowing the yard is okay. Well, in the financial world, it's a little hard. It's now, especially when we go through a down market, we have our costs going up, yet we have our revenues stagnant. And so it puts us in this stagnant growth, and we get tired, and we find ourselves working individually 70 to 80 hours a week. And we're trying to push this practice, this business, with all this in the back of our head. And without a CFO, either full-time or fractional, it's left up to us to make corrections amidst the storm. You see, a CFO will decentralize us. They'll allow us to spend more time either client-facing or working on our practice. They're going to allow us to do that without having to dive into the weeds. They're going to give us objective data versus oftentimes we can rationalize the data. I remember the first time I looked at our average account size per household. I was appalled at what I saw. And then I began rationalizing, well, it's okay because of this, and well, it's okay because of that. Yeah, our CFO, whenever I deployed this concept we're talking through today, they came and said, no, it's not okay. We need to improve this. And that leads me to a third point. A CFO will bring about accountability for you and I as business owners. So let's dive a little deeper and look at what exactly does a CFO provide us. I'll give you a few, but let's take a little deeper dive into this. Years ago, it was 2016, I came up with this moment in my life that said, I've got to change. I'm going to have to make some very hard decisions or else I'm going to be insane. Using the definition of insanity, we're doing the same thing over and over and over again, expecting different results. So I had to make some very, very tough decisions. Some decisions that where you draw a line in the sand that says, I candidly really don't care how this is going to impact this particular, whatever it may be, system, process, whatever it is. I don't really care how it's going to impact it because this is where we're going. And I realize I'm going to have to make some hard decisions now. What allowed me to reach that point was the fact that I was frustrated with the data that I was looking at. I firmly believe that we business owners are really bad at making decisions in a vacuum. We make decisions oftentimes flying by the seat of our pants. And candidly, it's what got us to where we're at. In the early days, it makes a lot of sense, but as the business matures, we need to start using data in order to make wise decisions that propel the business forward. So a CFO brings about accountability. It brings about accountability to the operations department, to the finance department, to the management or leadership of the company. You can measure so many components of your business by allowing a CFO just to do their job. It allows you as the business owner to develop financial and operational strategy and compare the risk associated with each strategy. Knowing that sometimes you're going to have to make stupid risk. You're going to have to take that entrepreneur spirit and say, here we go. Let's see where this one leads us and hope for the best. But having the financial data prepared for you to be able to look at it comprehensively allows you to make better decisions. It allows you to develop and monitor control systems. So let's go back to my example. Whenever I was appalled at the average account size per household, I began looking at, what was causing this impact? And so we were able to develop a system that would drive that particular number up. And then we began a monitoring process through the CFO work to help us keep the average household moving in the right direction. Perhaps the most important thing for me, though, using an outside CFO was analyzing the KPIs, the key metrics. So currently, I think whenever I sold my practice, we were measuring about 45 or so KPIs in just the finance section alone, just the finance section. It didn't happen overnight, but I could almost like a scorecard, almost like a pitcher's stat or a quarterback stats. I could see everything in the company and I could make micro tweaks, but it didn't happen overnight. What happened first was we began looking at some majors like cost of capital, return on equity, the hurdle rate needed for each decision that I was making. And because of the familiarity bias that most of us have, a CFO, in my case, allowed me to take a step back, get the data, and then bounce ideas off a person who was looking at pure data that wasn't perhaps as emotionally charged or as emotionally vested as I would be. So CFO is going to bring a lot to your practice. Now, again, only about 40% registered investment advisors use a CFO in any capacity. That means about 60% of my brothers and sisters out there are not currently utilizing this powerful tool. In fact, whenever I talk with financial advisors nationally and I start asking questions, very seldom do I see where a financial advisor has begun utilizing the functionality of a CFO. So that leads me into my question of, okay, Justin, if I want to use a CFO, where do I look? You know, what happens most of the time, and candidly, if I'm being transparent, this is where I started. I just started the practice, kind of retooled it in 16, and I was allowing an employee in the company to help me. Had an employee who would take all the bills coming in. They would take the bills and they would pay the bills. I would sign the checks. They would pay the bills. They would reconcile the checkbook in the old style way, right? They would reconcile the checkbook. They would do the billing for our accounts. They would make sure the billing was done properly for clients. I would get reports on that. Basic, very, very basic, just APAR is all it was. Accounts payable, accounts receivable. Very simple. And then what I would do is I would go into QuickBooks and I would run a journal position or a balance sheet income statement on a quarterly basis, on a monthly basis, just to kind of see what was happening. Because in a small business with 1 or 2 employees, you can probably run it all in the back of a napkin. But then things begin to get complicated. Now we're starting to deal with payroll and COVID and all this other mess that we deal with now that candidly 10 years ago we didn't have. So we start looking at our internal employee and we're like, they're not going to be able to provide me hurdle rate calculations. I'm going to have to spend my time there. So yeah, it's a lot less in cost for me to hire an employee. The quality's not going to be good. Do I trust them? Well, kind of, yeah. Do I have to oversee them? Of course. Do I have a lot of time involved? Well, not a lot, but as the business goes, it drains more and more of it. Is it expedient? Do I get the material I need in a timely fashion? Well, yeah, for the most part. And if it's a small business, I can walk into that employee and say, hey, run me a P&L of X, or hey, I need a check made payable to Y, and they can do that. But what happens is as the business grows, it becomes less and less of a priority for that employee. So then what we do is we start looking for what I did and where many people should probably lean toward is that of an external or fractional CFO. Now, let me define our terms. Whenever I think of an external or a fractional CFO, I'm looking for somebody who perhaps is working with 5 or 10 or 15 different businesses. They're qualified. They have some credentials, which we'll talk about in a second, and they perhaps are able to spend maybe 2-3 hours, 4 or 5 hours a week on our business, and we pay them for that. Now, the cost is going to be a little bit more expensive than an employee, but the quality should be, if we hire the right education level and experience level, the quality should be pristine. And we can build systems that will include our trust. I remember when I hired Patty. I'll tell you, my dear friend's name is Patty. I've known Patty now for almost 20 years. Her and her husband have a precious little daughter, about the same age as one of my children. And Patty and I were introduced through her husband. And I was looking for this fractional CFO, and her husband said, hey, my wife Patty's a CPA, stay-at-home mom, and we're just looking for some part-time work. Do you think she could help you? And I was like, well, I don't know. Let's figure this out. So we began building systems. Let me tell you, friends, I quickly learned that my time not dealing with finances allowed me to make more money, so much more that I was able to easily afford Patty and actually turn a profit. And the priority was there because every month, by the 10th of the month, Patty would have my financials package prepared for me. And then we began talking about KPIs. So then we began measuring KPIs and putting softwares in place. And then as the company grew, payroll was there. And she took care of payroll. And whenever I had unemployment things come in from the unemployment offices, she could take care of that. And she could collaborate with my IRS. She would work with my 401k company. She became a true CFO for me. Now, it costs a little bit more money, but it was really, really good. Perhaps now you've gotten to the point, though, where you're like, look, I need somebody who's going to help me 15, 20 hours a week. I was talking with an individual about a week and a half ago now, and they're a practice in Southern California. They have about 9 advisors together. They're producing somewhere around about $14 million in annual revenue. It's a good size financial advisory practice. It's a blended model. It's, we could talk about models at some point in the future, but it's an ensemble style practice. And Patty would probably not be the right solution for that practice. So now what they look at is they look at hiring either a completely outsourced company, like a large CPA firm, or they have the decision to, do we bring somebody in-house? And we're actually talking through this. And so we looked at the pros and cons of hiring an outside party. The cons are they're more costly. The cons is that oftentimes they're not as expedient as we might desire. The pros is that high quality. Oh my goodness, high quality, because they have systems and processes, the multiple eyes that check things. The pros is that there is an embedded trust working with a professional organization. The pros is that it will be a priority for them at the times when it needs to be a priority for them. So if we looked externally, man, we have some high cost. However, when we started comparing internally, we could go in and we could hire a dedicated CFO that may cost us anywhere between $125,000 to perhaps $250,000 a year, depending on the size of the practice, locale, time constraints, education, etc. So if we hired internally, it could cost us more or less than an external provider. The quality, would it be as high? Maybe, maybe not. It depends on acumen, it depends on a lot of different metrics there. Would we trust them? You know, trust is a very interesting animal, especially when you're hiring somebody to do a job. There's probably a greater trust factor by hiring somebody externally than hiring somebody internally with your money. But nonetheless, trust is there. I know several practices that have dedicated CFOs and the trust is impeccable. It's impeccable because the CFOs have built systems and processes to allow full disclosure. So there is a pro and con to hiring professional firms or hiring somebody dedicated internally. So now, friends, we've looked at how we can hire a CFO, but what do we look for in the person or in the company of the CFO? What are the qualifications, the compensation, the education perhaps that we'll be looking for? There was a study done by Schwab in 2015, and I had our team look for a more recent study. We couldn't find one that had measurements in it. We found lots of benchmarking studies, but in 2015, and we'll have a link to this in the blog, there was a report done by Schwab that said that in the RIA space, for those individuals who employ a CFO, 44% of the time we hire CPAs or certified public accountants. That's who we hire. My external accountant, Patty, was a CPA. She was a stay-at-home CPA who was raising her daughter, beautiful daughter, and she had the technical prowess to help me, and she had the time, and therefore I was able to use her and her abilities to help me in my business. So certified public accountants end up being about 44% of the time. Now, certified financial planners end up being about 28% of the time, which I found was interesting. I started asking and reading through the article and the study, and many certified financial planners or CFPs are a little bit more detailed than perhaps your financial advisor without that designation. We have to be a little bit more detailed in order to actually pass the exam. Perhaps we're more analytical and less sales driven. And that seems to be, as I talk with CFPs, that seems to be the personalities that we have. I know I am certainly more detailed than many financial advisors in the marketplace. But nonetheless, about 28% of the time, RIAs hire financial planners. And then about 9% of the time, we hire chartered financial analysts or CFAs. Now, CFAs are extremely detailed. At least that's been my experience, very detailed. And I've never met a CFA that serves as a CFO. I've never met that. But nonetheless, according to the Schwab report, about 9% of the time, RIAs would hire a chartered financial analyst. So those are the top designations. But more than the designation itself, let's look at the person. Because there's a personality profile that can often conflict with the proprietor or the principal or the entrepreneurial spirit of the RIA owner. See, CFOs are extremely meticulous. A true CFO is extremely meticulous. If they're off a penny, it'll keep them up at night. If they're off 1 cent, they literally stress over pennies. To me, I'm like, okay, well, it's a rounding error somewhere. Let's just, let's fix it. Oh, no. They're going like Mission Impossible. They'll don, the Tom Cruise outfit and go hang off the side of the airplane in order to find that penny. And that's what we need, especially when we're dealing with money in our business. This personality profile of CFO is one of meticulousness. They stress over pennies. They're often risk adverse. They're trying to look at all the what ifs, what all the pitfalls that can hurt us. They're looking at cash flow analysis. Again, KPIs are not unknown to CFOs. They can read the tea leaves, as the old saying goes. And so they're often risk adverse and they're cautious. Now, we can use that to our advantage to grow our practice to be that of 8 figures. We can use this. How? In my own strengths and weaknesses, oftentimes I can see in how the game is going to play. I love the game of chess. I can see 7, 8, 9 moves ahead of me, and I'm pretty good at it. I like the game of chess. One of my superpowers, as I've been told, especially as of late, is I can watch the business landscape within a business and kind of tell you what's going to happen and how to deal with it just before it does. Now, I'm not a prophet by no means or a fortune teller, but I can read business. It's like people I know who can watch a football game and know the play that's going to happen before it happens. It's like, how do you do that? They just know the game. They just know the game. That's my superpower. Perhaps that's not you. What I found was extremely helpful was having somebody who was monitoring the cash, the KPIs. As I'm looking into the future, they're seeing what's happening. And then we would come together on about the 10th or the 15th of the month, and I would say, here's what I think happened, what happened. So as I'm driving forward, looking forward, I have somebody right behind me saying, that decision you made, here's what it yielded. That decision you made, here's what it yielded. Hey, we're starting to see movement on this decision you made 4 months ago. We're starting to track that move in the right direction. That is a powerful tool for us as business owners. Powerful. So friends, when we start to look at this, we really have to ask ourselves, why? Why do we need a CFO? We know they can add value, but why do I? Why do you need a CFO? Because we can't see the forest for the trees. Okay, that's an old country analogy, but you're looking at individual trees and you miss the grandeur of the forest. This last week or so, my daughter had her senior trip and she wanted to go to California and see the redwoods. And here we are in one of the national parks, and we're looking at this one redwood, and it was magnificent, 300-something feet high, just a beautiful, just unbelievable, just really unbelievable for the East Coasters to come over and see these magnificent trees. And when I stopped and we're looking at this one tree, it's like, wow, check that out. And I looked and I just looked around us. I said, guys, stop and look. This one tree is duplicated all around us. We could not see the grandeur of this particular grove, is I think what they call them, this grove of sequoias. We couldn't see it because we were focused on the very first one we saw. It's called proximity blindness. There is a term coined by psychologists Arian Mack and Irvin Rock. So Mack and Rock, both PhDs, and they made this statement. They said, because this inability to perceive, this slighted blindness, seems to be caused by the fact that subjects, or you and I as business owners, were not attending to the stimulus when we weren't looking at what's happening around us, but instead we're attending to something else. We were putting out fires. We were listening to complaining in that moment. We labeled this phenomenon inattentional blindness, or IB. Think about this. That's exactly what we get. We get this inattentional blindness. And it's because we're dealing with the things inside our business which are needed, but it's not driving us to where we ultimately need to be. We can't see the forest for the trees. Or we're spinning a lot of plates, or putting out fires. Whatever your analogy you want to use, that's what we have. That's what happens in our business. So a CFO comes alongside and they say, "Hey, Justin, time out. Pause. Look." A CFO can provide you with much needed objective overview of your firm. Much needed. Elizabeth Thornton made this statement. It's a powerful statement. I want you to hear what she's saying here. Complete objectivity is not an option. Let me say that again, because you got to catch that, friends. Complete objectivity is not an option. We are all subjective about the way we respond to what is, whether it's the people we encounter, the circumstances in our lives, or ourselves. What we can do is reduce our subjectivity. What I call, I see, therefore it is. And Elizabeth's saying, hey, look, I call this, I see, and therefore it is. In other words, we make instant reactions because of our current worldview within the moment, and we're missing the grander picture. And a CFO, an external, can say, hey, time out. Let's look. Time out. You're not being objective, nor can you. Some people might call that familiarity bias. See, having a CFO allows you to focus on growth. Appointing a dedicated CFO decentralizes you from the catch point of all the financial things and allows you to focus on growth, the things that's really going to drive your firm to that 8-figure practice. And then when you're focused on growth and not dealing with the day-to-day crap that we all deal with, now we're able to take a step back and make decisions that ultimately we know we need to make. We just don't want to. And at the end of the day, whenever it comes time to go to market. Friends, this is a powerful point. This is my last one. So when it comes time for us to go to market and we're going through due diligence and we're now providing financial statements, the proposed buyer is looking at the financial statements. There is an unbelievable peace. There's an unbelievable value placed on the ability by having a third party, by having a dedicated CFO, by having somebody other than you, perhaps the largest shareholder in your business, by having somebody else say, these are the data points. 2016, I was working with my CFO and we built a performer like we talked about last time. And we got to the closing table. And I said, hey guys, I want to show you something. In 2017, this is what I said we were going to do. And here's where we're at. We missed about $30,000. And their minds were blown. How in the world? I said, because we made a plan. We stuck with a plan. We made hard decisions along the way. But I had people from the outside constantly pushing on me, the only owner in the company. And friends, a CFO will drive you. They will drive you. If they're a good one, they're going to drive you to the desire that you have. Perhaps, just perhaps, it could be the 8-figure exit. It could be. Now, that's a lot there, friends. I realize this is hard. Trusting people with your money, getting intimate with people around your finances of your practice, being authentic, it's tough. Doesn't have to be. I have a group of colleagues, man, that we've gone through this. We've each have gone through this, and we can coach you. We know how to help you. We know, if you're a financial advisor, what it's going to take to get you to the point where you can exit your practice for 8 figures. We know how to do it. It's not hard. It's not hard when you're on the outside looking in. Let's say it that way, because on the inside looking out is like, I'm drowning. We all get that. Again, if you're not a financial advisor, the same thing is true for your practice, your business. An outside CFO can help you drive value. And if you do it right, friends, it is a powerful, powerful exit tool that allows the buyer one day for your practice to come back and say, wow, this person really built a substantial and sustainable business. Therefore, we're going to give them Y in value versus X. Friends, I hope that helps. Till next time, y'all go out and make it a great day.